Let's pull our attention away from the usual circus for a moment. You know the one. The endless panels arguing about the Federal Reserve, the breathless debates over quarter-point rate cuts, the glowing charts of the same 5 tech stocks as if global reality begins and ends in a midtown conference room. Financial media has a talent for making you believe that the price of everything on Earth is decided by a small group of people wearing expensive suits, staring at Bloomberg terminals and nodding gravely at each other. Meanwhile, while everyone was distracted by that noise, something far more important was happening quietly, methodically, and with brutal efficiency on the other side of the planet. Something that doesn't fit neatly into a talking head segment or a 10-second chart animation. Something that forces us to rethink the entire silver market from the ground up. For months now, we've been watching silver tighten. Not in theory, not in models, but in the real world. Premiums creeping higher, inventories bleeding lower, bars leaving vaults and not coming back. We knew the metal was disappearing, but the big unanswered question was simple. Who was taking it? China was an obvious suspect. Industrial users were another. Maybe a shadowy hedge fund with deep pockets and a taste for chaos. Turns out we were thinking too small. The buyer isn't a fund, or a tech firm, or even a Western central bank. The buyer is India. Not one company, not one billionaire, but an entire nation stepping into the silver market with the subtlety of a wrecking ball. Newly released trade data shows that India has imported roughly $5.9 billion worth of silver in just the last 4 months. Let that number sit with you for a second. In silver terms, that's not participation. That's domination. To understand how extreme this is, you need context. From 2013 through 2019, India imported about $1.5 billion worth of silver per year. Per year. 12 months. Now they've brought in nearly 4 times that amount in a single third of a year. Compared to 2022, which was already considered an exceptional record-setting year, this current pace is about 64% higher. This isn't a trend. It's a step change. A vertical line on the chart. The financial equivalent of someone flipping the table and announcing new rules. This is what it looks like when a country collectively decides that holding metal is preferable to holding paper. And no, this isn't about bangles and wedding season. You don't need to vacuum up $6 billion in silver in 4 months because grandma wants a new anklet. That narrative is comfortable and therefore wrong. Silver is a global asset with a finite supply. There's only so much above ground, and mining output doesn't magically surge just because demand gets impatient. When a buyer this large shows up and absorbs months of global production in one shot, that metal is removed from circulation. Permanently. It doesn't teleport back into Western vaults. It doesn't wait politely on the sidelines. And where is this silver coming from? It isn't being conjured out of thin air. It's being pulled from the same places that supply the West. LBMA inventories, Swiss refiners, global warehouse systems that underpin the paper markets. In plain language, India is draining the West S buffer stock while analysts argue about whether a 10 basis point move was hawkish. The real story here is motive. Industrial motive, strategic motive. India is in the middle of a massive infrastructure and manufacturing expansion. Power grids, solar parks, electronics, electrification, all of it runs through silver. Photovoltaics, contacts, conductors. This isn't speculative buying. It's front-running a shortage. Indian industrialists can read the same supply deficit data everyone else can. They see geopolitical risk, they see declining ore grades, and they've decided that paying up now beats begging later, and the domestic markets are confirming it. The Nifty Metal Index, which tracks India's major metal and mining companies, is off to its strongest start to a year since 2018. Even more telling, the ratio of that index to the broader market is sitting at an 11-year high. Translation, capital is rotating out of general equities and into hard assets. Promises out, rocks in, paper sold, reality bought. Because when a country the size of India rotates, it doesn't tiptoe. It shifts the gravitational field. The global silver market has been running a deficit for years. We consume more than we mine. The difference has been made up by drawing down above-ground stockpiles. That only works until someone shows up with a $6 billion checkbook and empties the pantry. India didn't just buy silver, it bought the buffer. That's why the price behaves the way it does. Every dip gets bought. Every smash attempt fails to stick. Western banks can push the price down, but they can keep it there because there is a buyer underneath who doesn't care about momentum indicators. India has effectively become the put option under the silver market. If the price drops, they buy. If it rises, they still buy. That's what price inelastic demand looks like. And it's lethal to paper suppression schemes. Paper markets can be gamed, contracts can be printed, leverage can be layered on leverage. But customs data doesn't lie. You can't fake thousands of tons of refined metal physically crossing borders. The logistics alone are staggering. Secure transport, containers, insurance, refinery capacity. This isn't a theory, it's a paper trail measured in ships and vaults. And here, as a detail almost no one is talking about, logistics capacity itself becomes a choke point. If transport and refining are booked moving silver east, there's less ability to move silver west to cover short positions. The supply chain gets monopolized by the biggest buyer. That matters when stress hits. So when you see silver printing numbers in the mid-90s, understand that it's not an abstract price. It's the visible outcome of a bidding war. The West wants low prices to protect financial optics. The East wants metal to build the future. Right now, the East has more urgency and more conviction. And India isn't alone. While India is aggressively importing, China is doing something arguably more powerful. It's closing the exits. They're not just buying silver, they're restricting its export. The world's factory is deciding that processed metal should stay home, which brings us to Shanghai. While Western markets were congratulating themselves for flirting with $94, the Shanghai session posted a price north of $105. Let that sink in. While analysts debate whether silver can hold certain levels, the largest industrial economy on Earth is already operating at prices many said were fantasy. But the price itself isn't the real shock. The premium is. The spread between Shanghai and London, New York, has blown out to roughly $11 per ounce. To grasp how extreme that is, rewind to 2011, the last great silver squeeze. At the absolute peak of that chaos, the Shanghai premium touched around $7. That level was considered systemically dangerous. Today, we're 57% above that, and the gap hasn't widened slowly. It's exploded in weeks. This tells us the market isn't just stressed, it's fractured. A global market with an $11 spread isn't a market, it's a broken mechanism. Because arbitrage doesn't tolerate that kind of gap. If you can buy silver in the West and sell it in Shanghai for an $11 profit per ounce, every available bar gets sucked into that trade. It becomes a vacuum, a black hole pulling metal from low-priced jurisdictions into high-priced ones. That's why Western inventories are collapsing. Banks aren't selling silver to retail buyers. They're feeding arbitrage flows. Metal is leaving because the paper price refuses to acknowledge physical reality. So ask yourself, who is right? The leveraged traders in Chicago trading claims on metal? Or the manufacturers in China who need silver to build the solar panels powering the global grid? History is clear on this. The physical buyer always wins. And the most important signal is that the spread is still widening. If supply were sufficient, arbitrage would close the gap. It isn't closing. That means even with massive flows of silver moving east, demand is not being satisfied. China produces over 80% of the world's solar panels. A sustained silver shortage isn't just a market issue. It's an energy issue, a supply chain issue, a geopolitical issue. India is draining quantity. China is breaking price discovery. And the West is left arguing about charts while holding IOUs. This isn't a theory anymore. It's a receipt. Let's take this one step further. Because the implications don't stop at charts and premiums. China doesn't just assemble gadgets for the world. They produce the overwhelming majority of electric vehicle batteries, solar panels, and critical electronic components. And all of those industries run on silver. Not metaphorically, literally. If silver becomes scarce inside China, it doesn't stay a China problem. It becomes a global supply chain problem overnight. From smartphones to electric cars, everything starts to feel it. That $11 premium we're seeing isn't a curiosity. It's the market screaming in pain. It's factories bidding against factories for limited material. They're paying $105 not because it's fashionable, but because the alternative is shutting down a production line. When silver is a required input, price sensitivity disappears. You either pay or you stop producing. That's the inelastic demand thesis we've been hammering on for months, now confirmed in the most brutal way possible. So what does that mean for the US price? It means it has nowhere to go but up. This isn't ideology or speculation, it's physics. Liquids find their level. Markets do too, eventually. The Chinese price reality is dragging the Western price upward, whether New York likes it or not. And New York really doesn't like it. The banks are still trying to suppress the price to protect their short positions. They're dumping paper contracts, leaning on algorithms, doing everything they can to keep silver under psychological levels. Every smash looks impressive on a screen for about 15 minutes, and every smash makes the problem worse. All they're doing is widening the spread, making arbitrage more attractive and accelerating the drain of physical metal out of the West. They're trapped. If they allow the price to rise, their short books implode. If they keep the price artificially low, they lose physical inventory to China. They've chosen the second option. They're burning through real metal to buy time, effectively sacrificing national stockpiles to protect quarterly bonuses. It's not heroic. It's not even clever. It's desperate. And here's the part that matters. Inventories are finite. When the metal is gone, it's gone. At that point, the paper price stops mattering entirely. The only price that exists is the price required to get delivery. Right now, that price is already triple digits in the real world. So when you see $94 on your screen, understand what you're looking at. It's a ghost price, a legacy quote, a number attached to a promise that may or may not be honored when stress hits. China understands this. They've crossed the Rubicon. They've accepted that silver is strategic, not just another commodity, which raises a far more uncomfortable question. If China is already paying over $100 and still can't get enough metal, what comes next? Do they just keep bidding higher, or do they change the rules of the game entirely? This is where the story takes a darker turn. The evidence suggests China isn't just buying silver, they're locking it down, preparing to close the exits. Silver is becoming too valuable to let leave the country. Control the metal, and you control the future of energy and technology. That's not hyperbole. That's industrial reality. We are now seeing confirmation that China is quietly enforcing export restrictions on silver and silver-containing critical materials. This is the ultimate Roach Motel strategy. Silver checks into China, but it doesn't check out. And to understand why this is happening, you have to stop thinking like a trader and start thinking like a planner in Beijing. China is the world's factory. They manufacture the majority of the products the modern world depends on. For decades, the arrangement was simple. The West sold raw materials. China turned them into finished goods. Everyone got cheap stuff and pretended this was permanent. But resources aren't infinite anymore. Mines are aging, grades are falling, and China has done the math. They've decided they will no longer export raw silver, no bars, no grain, no refined feedstock. If you want silver from China, you'll get it embedded in a finished product. Buy the solar panel, buy the EV, buy the battery. This is value-added nationalism, and it's devastatingly effective. It's the equivalent of an oil producer saying, we don't sell crude anymore, but we're happy to sell you gasoline at a premium. It locks in manufacturing dominance and forces dependency. And here is the part that really hurts the Western paper markets. China is also a major silver refiner. A significant portion of silver mined across Asia and even South America passes through Chinese refining capacity. When China restricts the export of refined silver, they aren't just hoarding their own supply, they're choking off the supply line to London. The LBMA relies on global flows to balance its books. When those flows stop, the system seizes up. London is left trying to satisfy global demand with a shrinking pool of metal. The data explicitly confirms this. Export restrictions from China are squeezing the global market. This isn't an accident, it's policy. China sees the US and its allies talking about reshoring industry, securing supply chains, building domestic solar and battery factories. And China's response is simple. Good luck doing that without the metal. By hoarding silver, they're preemptively strangling Western reindustrialization before it even gets traction. This is the weaponization of the periodic table. At that point, silver stops being just a hedge against inflation. It becomes a geopolitical choke point. Access matters more than price. If you're a Western manufacturer, the reality is grim. You can't source silver from China. The US Mint is constrained. Dealers are rationing. You're entering an era of resource apartheid, where availability depends on geography and politics, not money alone. Before we go further, there's something important we need to address. We are boring currency. This is the original channel. Real people, real research, real data. We spend ridiculous hours digging through customs reports, vault statements, and trade flows, so you don't have to. Lately, we've seen a wave of copycat channels using our avatar, lifting scripts word for word, and pretending to be us on other platforms. Let's be absolutely clear. We have one YouTube channel. We do not sell crypto on Telegram. We are not asking for money on WhatsApp. Anyone using this avatar outside this channel is not affiliated with us in any way. They're lazy imitators trying to harvest fruit without planting the tree. If you value the work we do here, help protect this community. Drop a comment saying, staying with the original. We read them all, and it genuinely matters. Now back to the export lock. China closing the gates has massive consequences for Western prices. If the West can't import silver from the East, it must rely entirely on domestic production and friendly suppliers. But the US consumes far more silver than it produces. We are structurally short. We depend on imports from Mexico, Peru, and yes, China. If China exits the supply chain, the US deficit explodes. The price must rise high enough to attract metal from somewhere else, high enough to convince a miner in Mexico to sell to New York instead of Shanghai. But Shanghai is paying $105. New York is paying $94. That S, not a hard decision. So New York has to go higher, much higher. It has to outbid China. This is a bidding war for the last calories on the global dinner table. Export restrictions are the final nail in the coffin of the global spot price. We're moving toward a fragmented market where silver costs one thing in Shanghai, another in London, and something else entirely in New York. And in that chaos, the physical holder wins. Because physical silver is jurisdiction agnostic. An ounce is valid everywhere. A paper contract is not. China knows this. That's why they're keeping the bars. The mask is off now. Governments are no longer pretending this is a free market. They're openly fighting for control of resources. And this feeds directly into the next phase, the trade war. Tensions between the US and the EU are escalating, tariffs are spreading, and trade wars are inflationary by definition. For decades, globalization kept costs low. Mine here, refine there, manufacture somewhere else. It was efficient until politics stepped in. Tariffs, export bans, and supply shocks destroy efficiency. They add friction and cost. If silver can't move freely, prices rise. The Fed can raise rates as high as it wants. It cannot print a silver bar to bypass a Chinese export ban. This squeeze isn't monetary. It's structural. It's geopolitical. And it's accelerating. We're crossing into a new phase now, one where security matters more than efficiency, and security always comes with a price tag. What's fascinating is that the clearest proof the global financial elite understands this shift isn't IT coming from speeches or policy statements. It's hiding in plain sight, inside the stock market, in a place most Western investors never bother to look. There's a chart flashing red like a fire alarm in an empty building, and almost no one in the US is listening. The chart belongs to the Nifty Metal Index. For anyone who doesn't track Asian markets, the Nifty is India's benchmark index, their version of the S&P 500. The Nifty Metal Index isolates mining and metal-producing companies inside that economy. And the reason this matters is simple. India is currently the demand engine of the physical metals world. They are the buyer of last resort. They're the ones taking delivery. So if you want to know where informed capital's moving, you don't watch CNBC panels. You watch what Indian investors are doing with their money. And what they're doing right now is extraordinary. The Nifty Metal Index is having its strongest start to a year since 2018. It is not drifting higher, it's breaking out. But the more important signal isn't the absolute price, it's the ratio. When you compare the metal index to the broader Nifty 50, that ratio has just reached its highest level in 11 years. That's not a coincidence, that's a regime change. For more than a decade, paper assets dominated. Tech stocks, banks, consumer brands, anything intangible but scalable. Commodities were left for dead. But this ratio breakout tells you something fundamental has flipped. For the first time in 11 years, miners are outperforming bankers. Steel mills are beating software firms. Rocks are beating algorithms. Capital is rotating. And it's rotating because the smart money in the global south can see what's coming. They see shortages. They see trade walls going up. They see inflation baked into the system. So they're selling general equities and moving into producers of real things. This is the financial mirror image of the physical hoarding we've been discussing. When investors prefer a silver mine over a payment app, they're betting on scarcity, not growth narratives. That validates the silver squeeze thesis from a completely different angle. This isn't about retail buyers stacking coins in a basement. This is about global capital flows repositioning for a commodity supercycle. When the Nifty Metal Index breaks out, it's not just silver. It's copper, zinc, lead, everything that comes out of the ground. And remember, silver is mostly a byproduct. It comes from lead and zinc mining. If those mining stocks are ripping higher, the market is telling you it expects the value of what's being dug up to explode. That creates a feedback loop. Trade wars fuel inflation. Inflation pushes capital into commodities. Higher commodity prices raise production costs for energy and electronics. That feeds more inflation. Central banks can't stop that. They can hike rates, but they can't reopen closed trade routes or force China to export metal. In fact, higher rates may make things worse. Mining is capital intensive. Expensive money slows new projects. That keeps supply constrained longer. Central banks are trying to fight a supply-side inferno with a demand-side squirt gun. The breakout in the Nifty Metal Index is the canary in the coal mine, singing about triple-digit commodity prices long before Western markets fully wake up. And wake up they are. U.S. mining stocks are starting to stir. Silver pushing toward the mid-90s isn't happening in a vacuum. The trade war is the friction. Capital rotation is the fuel. Silver is the rocket. We're also witnessing the balkanization of price. In a trade war world, there is no single global price. There's a friendly price and an unfriendly price. Allies pay one number, rivals pay another. But silver doesn't care about alliances. It flows to the highest bidder. And right now, the highest bidder is whoever is most afraid of running out. India is afraid. China is afraid. Western dealers are afraid. That fear is what drives premiums. That fear is what drives panic buying. And that fear is what's forcing the system into its endgame. So let's look at where this leaves us. India is draining physical supply. Shanghai has broken the price mechanism. China has locked the gates with export restrictions. Trade wars are lighting the inflation fuse. And we're sitting around $94, staring at a chart that has very little overhead resistance. This brings us to the conclusion, and it's an uncomfortable one if you're still clinging to the old model. What we're witnessing is not a normal bull market. It's a planetary scale run on the bank. India has imported nearly $6 billion in silver in 4 months. Shanghai is pricing silver well above Western markets, creating a relentless vacuum. China is weaponizing exports. Trade wars are pushing capital out of paper and into production. These aren't isolated events. There are interconnected signals pointing to one mathematical inevitability. The era of cheap silver is over. It didn't fade out slowly, it ended abruptly. And once global supply chains fracture, price discovery doesn't just adjust, it transforms. We're entering what can only be described as the global Roach Motel era. Silver goes in, but it doesn't come out. China has one, India has one through hoarding and duties. The United States has one through tariffs and restrictions. Every major power is building walls around its metal because they know they can function without it. That means the global pool of liquidity, the silver that used to flow freely to balance prices, has evaporated. If London needs metal, it can't just pull it from New York. If New York needs metal, it can't call Shanghai. Fragmentation guarantees volatility, but more importantly, it guarantees convergence. The cheapest market must rise to meet the most expensive one. Right now, the US is the cheapest market. Shanghai is already far higher. That gap cannot persist. Arbitrage, smuggling, and desperate industrial buyers will attack it until it closes. They'll buy every available ounce until New York reprices. A double-digit gap is mathematically embedded at this point. This isn't speculation, it's fluid dynamics, which brings us to psychology. We're hovering just below the most important number in Silver Acus history, 100. When silver crosses that level in the US, it will trigger a media frenzy unlike anything we've seen so far. Headlines will scream, commentators will panic. The public, who ignored silver at $20 and scoffed at it at $50, will finally capitulate at $100. That's human nature. People chase confirmation, not value. But this is also where the danger lies. Expect extreme volatility around that level. The banks know retail is emotional. They know leverage will be involved. Don't be surprised if silver spikes and then violently reverses as they attempt one final shakeout. Your strategy matters. First, don't trade the breakout. Trying to day trade triple-digit silver is a great way to donate money to professionals. Volatility will be brutal. $5 candles in both directions. Sometimes the smartest move is doing nothing. Second, watch the street price, not the screen price. Dealer reports already show physical trading well above paper quotes. That premium is protection. It insulates you from paper games. Third, adopt the wealth transfer mindset. You're not holding silver to get more dollars. You're holding it to exit a dying system. When the time comes, don't trade it for depreciating currency. Trade it for productive assets, land, businesses, debt freedom. This global squeeze isn't random. It's how the ledger resets. It's transferring wealth away from paper structures and back toward producers and savers. And if you're paying attention, you're already on the right side of it. So here's where we stand. India is buying relentlessly. China is paying whatever it takes and locking the door behind it. The US is staring at a shortage it can't print its way out of. And the price is only just beginning to reflect reality. $94 isn't the top. It's the signal. The squeeze is global. The shortage is structural. And the opportunity is generational. Thanks for being part of the boring currency community. These are fast-moving times, and the noise is loud. We'll be here tracking every ounce, every vault, and every narrative shift. Leave a comment saying, staying with the original, so we know you were here with us. The world is changing. The wealth is moving. And this is not the moment to let go of the rope.